Lululemon is down around 16% after reporting their earnings, as we can see down 21% year to date. Now, has the market overreacted and given us a very nice opportunity to buy this now undervalued company? Let's take a look in today's episode. As always, we'll look at the historical performance of this company. We'll look at their revenue growth year on year, top line as well as bottom line net income. We'll also look at the health of this company, total cash versus total debt. We'll see how they've performed versus their competitors over the last few years to see if they are one of the leaders in the industry. We'll also touch upon the institutional ownership, whether or not these huge institutions, and we'll also touch upon some insider selling that we have noted over the last few months. We're going to take a look at some of their metrics, notably their free cash flow per share growth over the last few years, return on invested capital, and a few others. We also want to take a look at their earnings, which was the main driver for this share price plunge that we see of 16%. And we'll take a look at this PDF that they have produced for their investors, not just for their latest earnings, but also for their full year FY23 results. Now, as always, we will run them through the valuation model. We want to get to our intrinsic value as well as our acceptable buy price given our investor margin of safety, and see what Wall Street are forecasting over the next 12 months. We're also going to take a look and run them through 3 different growth rates, a low, medium and high, to understand the expectations and where our price targets are coming from for this company. So let's start off, let's take a look at essentially the historical performance. Now, yes, they are down 21% over the last year to date, so just a few months, in fact Q1. However, over the last 12 months, they are still up 33%. We can see they trade in the mid to lower end of the 52-week range with a forward PE of 28.4. Now, if this is one you have held over the last 5 years, well, you would be up a fairly strong return, up 182%. So let's take a look and understand where this company is going and the issues that have happened for this share price drop. And we can see their 52-week high at $516 does give us some signs that there could be a very nice increase to this share price if we do believe it is undervalued. So let's take a look. We can see now they did drop around 16%. The large driver for this is their weak guidance as well as some sloth in the North American growth. Now, numerically, in terms of their earnings, they did a double beat, so they beat on the EPS, coming in at $5.29 per share versus the $5 expected. On top of that, revenue came in at $3.21 billion versus $3.19 billion. So very nice to note that they did beat on earnings per share as well as their revenue. On top of that, their net income for the 3-month period that ended in January 28 was very strong, $669.5 million. When you compare that to essentially a year early of $119.8, we're talking essentially nearly 6 times growth on that bottom line. So lots to love there, as well as the sales over the last year up 16%. Now, there are some issues that did come essentially from this guidance as well as from their earnings. One of them notably being that there was a slowdown in the North American sales. Now, we see it did go up 9%. You may think to yourself that's still very solid. However, when we do compare that to a year ago, that was up 29%. Now, in my opinion, the markets have overreacted here. Yes, North American sales have dropped from the previous year, but when you take a look, international sales up 54%, very strong. A large driver of this, China sales up 78% as well as 36% from other regions. So there are some things to consider. Yes, North American sales are slowing down, but they are taking advantages of other markets, which is very strong and can help them continue to increase and continue to grow. But we will take a look now shortly at the valuation as well to understand whether or not that has been incorporated to that price drop. Now, one of the other main reasons, other than the North American slowdown, that the price dropped essentially was due to the fact that their forward guidance wasn't as high as what management were expecting to be. We can see that they expect now for the current quarter their net revenue to be between $2.18 billion to $2.2. Now, this is a growth of 9 to 10%. We can see analysts were expecting higher, $2.25 billion, with double-digit growth of 12.5%. Not just on the revenue was there that weaker guidance, but we can also see on the earnings per share, 2.35 to 2.4, well below the 2.55 that analysts were expecting. So Yes, in my opinion, we did see some nice growth. They did beat on the earnings per share. They beat on the revenue. However, the weaker guidance has forced the market to drop that share price, which in my opinion, if we take a look at these other metrics and they are very solid, then this could be a very good opportunity to consider a position, or at a bare minimum, add it into the watch list. Now we can take a quick look at the investor presentation, just a few things to point out for those that like to see the numbers and some fancy pictures. FY23 results were 9.6 billion, up 19% from the previous year. Very strong adjusted earnings per share, up 27%, and comparable sales up 14%. So we're talking about double-digit growth, very, very strong. Q4, just looking at that quarter, up 16% on revenue, earnings per share up 20%, comparable sales up 12%. So they are essentially growing very, very rapidly in my opinion, and we can take a look to see whether or not that is supported by the other metrics. If they can continue to increase their revenue by around that 20%, EPS around that 30%, then this could be a very strong company in my opinion. Now let's take a look at their top line over the last few years. Typically what we like to see, 3 to 7% growth. However, this is a faster growing company than those that we typically look on the channel. 4 billion reported in terms of the top line in 2020. Now we take a look at their more recent period, Jan 2024, 9.6 billion. So very nice to note that they have essentially more than doubled their top line over the last 5 years. And we look on a more granular level, we see increases year on year. So that is a very positive sign. Remember, over the last 10 years, we'll also look at the percentage increase too. Bottom line, nice to note as well, 646 million in 2020, and we can see more than doubled, in fact, to January 2024 at 1.6 billion. And then when we do take a granular level look, we do see a little bit of an inconsistency. It did drop in January 2021, but since then it did go up in January 2022 before dropping and then going up. So top line, in conclusion, increasing year on year very strongly. Bottom line, net income over the longer period increasing very strongly, but there are those inconsistencies where we do see it go up and down year on year. Something just to consider and maybe factor in when we do look at that essential margin of safety. Quick health check then, total cash and short-term investments versus the total debt, 1.1 billion in February 2020. 2.2 billion in their latest report. So their cash position has more than doubled over the last few years. Yes, that is a fairly positive sign, but also very imperative to understand the movement in their total debt numerically and directionally. And we can see it has gone from around 740 million in February 2020 to around 1.4 billion. So what we note here is their total debt has actually doubled. However, their cash position is larger than their total debt. So off the bat, no real worries, but we can take a very quick look at their net debt to EBITDA shortly as well. Now, taking a look at their total return over the last few years versus some competitors, we have Kering, we have Adidas, as well as a few well-known others, including Ralph Lauren. Over the last year, they have returned 33%. We do see them as the third best performing in the industry. And when we zoom out to over the last 5 years, in fact, they are the best performing, beating the likes of Kering, Adidas, Ralph Lauren, Tapestry. So that is very positive to note. And in fact, 182% return over the last 5 years is also positive. But remember, it is key to understand that past performance is never an indicator of future performance. Institutional ownership, now it sits at 92%. We see around 7.7 billion worth of sales by these institutions over the last 12 months. But we note a lot more buying, in fact, around 4 times as much over the same period. So institutions do love this stock. It is one they are buying for their portfolios. And we can see essentially in Q1 there was more selling than buying by the institutions, but every quarter since then we see the opposite with a lot more buying, especially in Q2. So overall, institutions are very bullish on this stock, as well as the more recent quarter with more buying than selling. In terms of the insider selling, now we did have to zoom out a little bit. We normally like to see around 1 to 2 months so that it is a bit more relevant, but we want to see the latest point of any insider buys or sells. So we can see just before 2024, so the middle of December 23, the CEO, CFO, as well as the Chief Brand Officer and the American and Global Guest President have sold a fair number of shares. We can see the CEO, Calvin McDonald, sold around 12.4 million worth of shares. Now, typically we like to say insider selling, it isn't a bearish signal because they do sell for many reasons, personal, financial. We can see, however, since they've all sold, all 4 of them, the share price is down around 18 to 20%. Again, something to consider, but I wouldn't take this as something really to factor in your investment decision. Now, before we jump into and look at the metrics, just to let you know, we have released our latest free weekly article to the newsletter. If you want to gain a copy or take a look at any of our other weekly articles, all completely free, do click on that pinned comment below. Now, free cash flow per share, typically we do like to focus on free cash flow over the earnings, which is susceptible a bit to essentially manipulation by management through their accounting. $1.35 in 2015, $13 in 2024, some real strong growth over the last 10 years. Now, a few things to point out. In fact, from 2015 to 2023, before that massive year in 2024, there was growth, although very inconsistently. And another thing we do want to mention, 2025, it is expected to drop down to around $11. So, few things to consider here. However, over the longer term, they are growing their free cash flow very, very strongly, and that is a very positive sign, which, based on management's guidance and their performance over the more recent period, it doesn't look like it will be slowing down. Sales growth, this is what I love to see. Double-digit growth every single year. Very, very strong. 2024, 19%. This is something that essentially shows us that it is a fast-growing company every single year. And what we can see is it's not a company that we typically review where it's fast-growing and the growth starts to slow down. It is inconsistent, but nonetheless, it is still looking very strong. And based on their guidance, they are expecting around that 9 to 10% for FY25. Total sales were $1.8 billion in 2015, $9.6 billion in 2024. Again, over the longer term, they are growing this company very strongly and have grown it around 5 times that top line since 2015. Shares outstanding, again, very positive to note. They are essentially returning that excess cash to your pockets, giving you a larger piece of the pie. 144 million in 2015 to 127 in that more recent quarter. ROIC, what more do you really want? You're getting consistency here and double digits. Remember, we typically like to see a minimum of that 10% level just to give us faith that management are able to effectively allocate their capital, and we're seeing some very strong consistent numbers from this company and brand. Margins very healthy on the operating side. We want to see a minimum of 16%. You could argue it has been increasing over the longer term, and 23% in the more recent year is very healthy and positive. Free cash flow margin as well, looking very nice. We want to see a minimum around 5 to 7% at the baseline. We do note it did dip in 2023. However, it did rebound very strongly in 2024 to 17%. And whilst it may be something just to keep an eye on to consider it doesn't drop again, overall, both margins are giving a very good impression. Net debt to EBITDA, I love this. Earnings before interest, tax, depreciation, amortization, showing us the strength of the balance sheet over the last 5 years and expected next year. It won't even take them one day to pay off all of their debt net of cash on hand. So now let's jump essentially into the valuation of this company. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically we do run through every single one of these models to get to our answer. We use the Graham's valuation, multiples, we then move on to the dividend and then the discount. Now, for today's episode, we just really believe that this is the most accurate and it is the one we will use. Now, for the discounted cash flow model, we have the free cash flow year on year. Average growth rate, 19%. Now, forward looking, we have gone a little bit higher than the average for 22%, and we will consider the 3 different forward looking growth rates of low, medium, and high. Based on the 22% growth rate forward looking, we get the present value of future free cash flows and terminal value. Add together, essentially using that discount rate, we add together the present value of the future free cash flows, add the cash, subtract total debt, get to the equity value, divide by shares outstanding to get to our intrinsic value. Now, one thing we do want to mention for this calculation, we have taken the 2024 position as the 2022 number, given we did see that significant drop into 2023. So just one factor to consider. Now, this gives us an intrinsic value of $489. Now, for those that believe this is too high or too low, we have 2 different ways that we're going to go about it. So that was a medium estimation. Using a lower growth rate of 20%, so slightly higher than the average over the last 10 years, we get 20% coming to an intrinsic value of $435, giving us upside of 7%. Now, we did just run through what the medium of 22%, and as you can see, it would give you a value of $489, an upside of 21%. Now, the high rate that we have used is 24%, and this, as you can see here, gives an intrinsic value of $549. And as you can see, upside of 36%. Now, it really does depend on which growth rate you do want to use, depending on your beliefs. And as always, if you do grab a copy of this valuation model by clicking on the pinned comment below, you can run all of these models, whether it's Lululemon or other companies, based on your own estimates and judgments. So let's take forward the medium of 22%, and this gives essentially the intrinsic value, as we mentioned earlier, of $489, and we are just using this one model today. So the current price around $405. As always, we want to use a margin of safety, and we start off position at 10%, which we believe if a company has a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe this with a Lululemon, then you would be looking for a buy up to $440, signaling a buy right now. At 15%, $416, and we keep going till it's near the current trading price. 20%, it isn't quite there at $390. However, the price did drop that low when the earnings did come out. So right now, based on our estimates and judgments, we are looking at a 15 to 20% margin of safety level. In terms of Wall Street and their forecast, well, over the next 12 months, they see the price going up to $516, upside of 27%. As always, let me know your thoughts in the comments below. Is this one that you do believe is a very strong undervalued buy now? We have run through it. Again, it will depend as an investor what your margin of safety is. Are you looking for 15%? Are you looking for 20? Are you looking for 25? For those that are very conservative, at a 25% margin of safety, it would be at 367. And for those at 30%, around 342. So again, it does come down to your belief, one, in the company, if you do want to add it to your portfolio. And then the second thing here, which is the key thing, is getting it at the right value, which for today's date, we see at the 15 to 20% MOS level, with Wall Street forecasting 27%. As always, don't forget you can click on that pinned comment below if you want to grab a copy of this model. If you enjoyed today's episode, smash that like button, hit that subscribe button, and as always, we'll see you on the next one.